For decades, the 60/40 portfolio was the gold standard of retirement income. 60% stocks, 40% bonds. It wasn't flashy, but it worked. Through recessions, booms, crashes, inflation, it stood the test of time. And if you look back over the last 50 years, you'll see why. It offered solid returns, reasonable risk, and most importantly, predictable income. But, and here's the question every retiree should be asking right now, does it still work? Is it relevant? Is this the best path?
The truth is, the world that made 60/40 work no longer exists. Bonds, the safe part of your portfolio, used to yield 6 to 8%. Today, you're lucky to get 4%. And stocks? Well, stocks have had an incredible run, but they're more volatile than ever. When both stocks and bonds fall together like they did in 2022, that diversified 60/40 portfolio suddenly doesn't feel so safe anymore. So here's the tension. You still need income, you still need stability, but the old formula isn't cutting it.
What if there was a better way to build retirement income, one that actually reflects the world we live in today? A modern version of the 60/40 portfolio. Call it 60/20/20. 60% stocks for growth, 20% bonds for stability, and the final 20%, a bond enhancement. Something that acts like a bond, but better. And no, I'm not talking about an annuity. This isn't life insurance. And it's definitely not some complex Wall Street product that even your advisor struggles to explain. This is something real, something you can see and touch, an investment that delivers consistent income, not through financial engineering, but through real assets that people use every day. It's a strategy built on long-term stability, steady cash flow, and contracts you can actually read and understand. It all points to one thing: net lease real estate, real assets, real tenants, real income.
Now, before you roll your eyes, yes, I said real estate, but I don't mean flipping houses or becoming a landlord. You're not fixing leaking toilets or chasing tenants for rent checks. We're talking about a niche in commercial real estate known as net lease, a space often labeled specialized, yet it represents one of the largest and most stable segments of the entire real estate market.
The U.S. net lease market represents over $5 trillion in property value, one of the largest, most stable income-producing sectors in all of real estate. It's massive, but still not mainstream. Why is that? Because for decades, it's been dominated by institutions, pension funds, insurance companies, and REITs, the players who crave steady, bond-like income streams backed by long-term leases to household names. But that's changing fast. Today, through private partnerships and LP structures, individual investors, even retirees can finally access the same type of assets once reserved for Wall Street. They're investing in properties leased to big national brands like Starbucks, 7-Eleven, or Chick-fil-A. Companies that sign 10, 15, even 20-year leases. They pay the rent. They handle the taxes. They maintain the property. You, the investor, simply collects the income. It's predictable. It's contractual. And it can be as passive as owning a bond, but with several powerful twists.
First, the income is higher. Investment-grade net lease properties often yield between 6 to 8%, compared to 4% from bonds. And not only that, but that income increases as rent increases every year. Second, there's appreciation potential. The property itself can rise in value over time. Bonds can't do that. Third, there are tax benefits, depreciation deductions that can shelter part of your income, and the ability to defer capital gains. That's income stability, growth potential, and tax efficiency, all in one investment. Your 4% bond isn't looking so hot when you can replace part of it with this bond enhancement called net lease that can generate returns of 10% plus with very low risk and passive income that's not correlated to bonds or stocks, therefore improving your portfolio's risk-adjusted returns.
Of course, nothing is risk-free. Net lease properties can lose value, and the tenant can go bankrupt, which creates uncertainty. But here's the key. When structured properly with strong credit tenants, long leases, and conservative financing, net lease real estate behaves much more like a bond with equity upside than a speculative real estate play. You're buying predictable cash flow, not chasing appreciation.
So imagine this, a portfolio where you still have growth from stocks, some safety and liquidity from bonds, and a steady monthly income stream from net lease properties that act like corporate bonds on steroids. This is the new and improved 60/40 portfolio, which is now 60/20/20, a strategy built for the modern retirement environment, one that values stability, income, and tax efficiency. This isn't hype. It's not a get-rich-quick scheme. It's a smarter way to structure your wealth so you can actually live off your investments and still sleep well at night. Mailbox money.
If you want to learn how to build your own bond-enhanced portfolio using net lease real estate and explore how we can help you get started or even invest alongside us, just reach out or drop a comment below. It's simple. There's no pressure and no obligation, just a chance to understand a smarter, more stable way to generate income in retirement. We're here for people who care about protecting what they've built and who are ready to explore better, risk-adjusted ways to make their money work for them. So make sure to hit subscribe, because the 60-40 portfolio may be dead, but your retirement income doesn't have to be. This is Mailbox Money. I'm that lease guy, turning stress into sunsets, one lease at a time.